Today, as Richard just mentioned, I'm going to cover both something on the outlook for 2019 and beyond in terms of the real estate markets in Central and Eastern Europe, and also touch on the co-working phenomenon in the region and drilling down a little bit into Budapest. So first of all, on the outlook, we, as we were last year, have approached a record in terms of the investment volumes in the CEE region. On this slide here, you can see last year in the CEE 6 countries, so that's the Visegrad 4 countries, Poland, Hungary, Czech, Slovakia, and Romania and Bulgaria added to that. We had 13.9 billion of volumes. That was up 7% year on year on the previous year. Now, the important thing here is that the rate of change of that growth is slowing, so that we're starting to reach the top of the mountain, if you like. And I don't know if you saw very briefly, the title of my presentation was Climbing at Altitude. And it's really that when you're climbing at altitude, you've got to think about the amount of oxygen you have, you've got to think about your planning, you've got to think very carefully about what you're doing when you're climbing high in mountains. And that's really sort of the theme of what I think we should be thinking about over the next 12 months or so in terms of where we are in the economic cycle and the real estate cycle. But in terms of absolute investment volumes, pretty high volumes, and I'll go on to describe a little bit about where I think those are going. Just briefly slicing and dicing up that 13.9 billion euros last year, Poland returned to dominance in the region last year. Around 60% of flows came into Poland, 41% up compared with 2017, so a bounce there. It was really Czech Republic that we saw less volume. We had a very strong 2016, very strong 2017 in Czech Republic, down 30% last year. So weaker flow there. The main issue there is really the lack of very large deals, a lack of supply of very large deals in the Czech market. The other markets broadly stable. Hungary certainly flat at around 1.887 billion of volume last year. If we dice it by sector, it was really a return to prominence of the office sector. So office volumes rebounded 59% last year, so up to nearly 5.8 billion of volumes there. It was the retail sector where we saw some slippage, down around 7%. If we look at the figures, down 7% year on year, but still 4.7 billion, still very important as a sector. The industrial sector, which is always a decent proxy on GDP in the region in terms of seeing the correlation between them, up 20% last year across the CE region. Those transactions tend to be large portfolio transactions, particularly from investors from Asia. So the industrial sector still indicating to us that the volume is still pretty strong and the economic momentum is strong. If we look at where the volumes are coming from, so where the investors origin is into the region of this 13.9 billion last year, similar pattern to what we've seen in 2016 and 17. So on this left-hand side chart, you've got the traditional sources of capital into Central and Eastern Europe in the blue. So you've got there Western Europe, you've got the UK, you've got the US in those blue colours. It's around 45% of flow still coming from those sources. But from 2016 onwards, we've really seen what I called the changing of the guard in Central and Eastern Europe, that we had three new sources of capital. We had Asia, we had South Africa, and we had domestic flows in Central and Eastern Europe. So there, in 2018, Asian flows increased again up to 9% of the total. They again, as I mentioned with the industrial, they tend to be larger transactions, portfolios that are sold to the Asian investors at this stage. But we are now seeing, particularly in Poland, for example, we are seeing now transactions by investors from South Korea, from the Philippines and from Malaysia, buying individual assets. So they're starting to diversify down from portfolios. South African's still strong there in the gold, 10% of flow last year, so still buying retail assets, in particular in Poland, in Bulgaria and in Romania last year. It's the grey flow that I'm also particularly interested in, so domestic flow there in the light grey and the dark grey, 6% of flow is actually cross-border, so this is in particular Czech money, Slovak money going elsewhere in Central and Eastern Europe. And we're starting maybe, I believe, over the next couple of years, maybe to see Hungarian money start to be exported to the rest of the region as well. So if you add those two together, that's 30% of total flows. And 30% of total flows is significant. It's 1/3 of flows. So really a significant story there from the domestic side. And this, for me, is important through an economic cycle, through a real estate cycle, that this domestic money has appeared. It's more stable. It's less volatile. It also looks at assets that are maybe less prime. and therefore is an important indicator, important facet for a real estate market to have. And it's present in Asia, it's present in America, obviously, and in Western Europe. And in Eastern Europe, it's finally appearing as a much more important asset class. Now, within the region, Hungary has a large proportion. Around half of flows in Hungary are obviously domestic flows. Czech is very high, nearly 40%. Slovakia is also reasonably high. Some of the other countries, Romania and Poland in particular, very, very low in terms of their domestic pie. So it's really sort of quite strong differentiation across the region in terms of where the money's coming from. On the right-hand side, now, same colours. You can see those blue colours are much bigger on this right-hand side chart. So US investors in particular, but also UK investors, last year were net sellers of the CEE region. And Western Europe was only just a net buyer, if you take all Western European countries together. So there we're seeing a continuing trend. This was the case in 2016, it was the case in 2017, even looking back at 2015 as well. That for 3 or 4 years now, these regions have been net sellers of real estate in the Central and Eastern European region. So this momentum still hasn't stopped. Now, why are the US funds selling? A lot of them are more private equity orientated. They've made strong returns and they're cashing out. So that's an interesting sign in itself as to where we might be in the cycle. So just some observations there on the selling side. Now, just to finish off on where we are, just the yields. The prime yields that we have in the region, obviously some spectrum here from left to right in terms of Prague and Budapest, Prague and Warsaw in particular, the low yields on the left, Budapest there with yields falling across the board over the last year. We predict, if you look in the light blue, with the light blue arrows, that we will see further compression in yields in Budapest over the next 12 months. You can see that that's the only market where we see consistent yields falling consistently across these 3 key sectors: office in dark blue, light blue of industrial, and retail there. 6% yield. It's actually with the Mammoth transaction in Q4, that's coming at 5.8, so that's even compressing below that 6% figure now. Obviously, elsewhere in the region, Bucharest and Sofia in particular, there's still an opportunity for investors to take a higher yield and buy assets in those countries. So there's still an attraction towards those higher yields if you can get the funding. We looked at funding rates in our 2019 outlook, and those funding rates are giving us still quite substantial gaps, premiums from between the funding rate and the actual yield. So still quite an opportunity here. Because, in particular, the ECB is keeping interest rates at 0, that these funding rates stay low. And this is actually, for me, the major factor to think about in 2019 is the fact that interest rates stay very low. And that means that the real estate cycle in this region will not, if it does turn down, it will not turn down very quickly, because those interest rates are very low, gearing is not too high. So therefore, I think these yields are still relatively attractive. And as said here, in 5 of the 18 categories across these capital cities, we see further compression. So we see no yields going up at this point, but still some compression, particularly here in Budapest. Now a bit on why. What we've got here is in the dark blue, I've got here the flows that I showed you on the first slide. So slide 2, the presentation, but they are just plotted here 6 monthly. So that's the dark blue line on this chart, a bit zigzagging upwards because the second half tends to be bigger than the first half each year. But what I've got here is in the light blue is a composite sentiment indicator for all of the Central and Eastern European countries blended together. These are Eurostat figures, they're collected monthly, but I've lagged it by 18 months. I pushed it out 18 months in time, and I believe that it leads the real estate flows in Central and Eastern Europe. I've published this chart each year for the last 2-3 years. It's worked so far in terms of prediction. It has just peaked out, so that blue arrow on that chart suggesting some kind of dip going on in consumer sentiment. Finally, this consumer sentiment cycle appears to be peaking out if we take these Eurostat sentiment figures as a good guide. So maybe in 12 or 18 months' time we do attain the peak. Maybe we are turning over the peak in terms of the overall economic sentiment in the Central and Eastern European region. And the reason that we may be doing so is that the industrial side, we are starting to see a deterioration, a clearer deterioration in sentiment in Europe. There's various other global issues going on. China is slowing down, but Germany is the locomotive for Central and Eastern Europe. So here I've got the German IFO survey in the grey colour, and this time I've lagged it by 3 months. I pushed it out 3 months in time, and actually the value of that index in February came in at 93. So if we plot it in March, it will probably be well below 95 there. So this grey line is starting to fall away. So this is a German economy that might be in recession. Technically, it has just avoided recession, growing at 0.0% in Q4 2018, 0.0, no growth. There's no growth in the German economy right now. Now, there's lots of reasons for that, and maybe the panel will go into the details, but the fact is that economy is starting to struggle, and it is the locomotive for the region. We cannot escape this, and therefore, if we look at industrial sentiment in CEE, the light blue line on this chart is starting to follow it, and starting to come down. So we've got to be aware of this. This is on the growth side, particularly into 2020, this starts to become a more important factor if our industrial sentiment has started to fall away. And we can't escape it because Germany's locomotive exports to GDP from Hungary and Slovakia and Czech Republic are over 80%. They're very, very big figures. A lot of that goes to Germany. So we can't escape this inevitability, let's say. And in the past, you can see back to the year 2001, this pattern is broadly correct. So that's what we face. Some deterioration, but so far the German economy is not collapsing. It's just not growing at this point. But we have to see where it goes from here. There's many directions for it to go over the next 12 months, and many factors that can influence it. So just completing the outlook side of things. First of all, as mentioned, on the positive side, the fact that the ECB keeps interest rates at 0 is very important, and it keeps funding costs very low. The interest rate rises that we have seen in America and in emerging markets, so for example in Romania or in the Czech Republic in this region, we don't see so many of those happening this year in 2019 compared to the last couple of years. The economic sentiment I just mentioned is still at high levels. I'm not saying that we're plunging into a crisis right now. We've still got very low unemployment in the region. We've still got high consumption levels. We've got high wage growth across the sectors, and that affects some sectors positively in the region. We've got investment supporting economic activity. So all of these things are still happening in Central and Eastern Europe. We're not entering a recession here. We've got low vacancy rates, so rents should stay pretty firm. We've got a good fiscal position. So the governments have got, apart from in Romania, have got money to be able to spend if we do have an economic slowdown. So if Germany does slow, then there is the ability for our governments in the region, in 5 of the 6 countries, to actually spend a lot more money on projects to keep the economies going, to keep unemployment low, and to execute what they call counter-cyclical spending. So that's there. So for me, if we have a slowdown, it's going to feel more like 2000 to 2002 period than the actual global financial crisis of 2008-9. On the negative side, what can go wrong? First of all, that German economic sentiment is deteriorating. We are possibly in recession now in Germany. China's economy is slowing down. The auto demand in China is slowing down by 18% year on year, the car demand. It's the world's largest car market. Now, that really matters to Central and Eastern Europe when you're talking about Slovakia having 35% of its exports connected to autos, and the figures in Hungary and Czech are not that much lower. So we've got to bear in mind that the global auto market in particular is suffering, and there's many reasons for that, but it's happening and we can't escape it. The rent growth I mentioned is likely to lose momentum. As I mentioned, the consumer sentiment is turning, so I do see that momentum does abate, does drop away. And then we've obviously got some specific global factors going on. We've got trade wars, probability of continued trade war between US and China, perhaps something happening between Germany and the US in terms of certainly the auto sector. We've got the Brexit issue. We've got the Chinese financial sector, which I still very much believe is very over-leveraged. We've got a reset of credit markets going on globally, which is a bit of a problem in terms of global liquidity. So these things can pressure risk asset prices. And then we've got a specific risk, competitiveness risk, rising in Central and Eastern Europe. What I've found is in looking at the World Bank Ease of Doing Business analysis is that the Central and Eastern European region is dropping its ranking relative to other countries. So if we put in the survey New Zealand at the top and Somalia at the bottom, 190 countries globally, Central and Eastern Europe is doing okay, but other countries are doing better. So their rankings are falling. So Central and Eastern Europe has got to keep running. It's got to keep running to stay competitive, because otherwise in the global economy in 5 or 10 years' time, Asian countries, Latin American countries, African countries even will have caught up. So Eastern Europe's got to stay on its toes, as we say. And then finally, a factor, taxation risk that I've mentioned in all of my presentations, that we are seeing more and more evidence of potential for taxes to be increased on assets relative to taxational labour across the world. And a lot of the voting that we've seen in various elections or referendums or whatever we've seen, I think are connected with this issue of inequality, and therefore the taxation risk we cannot ignore in the real estate markets, being essentially asset holders. So that's it on the outlook. Just then to talk about co-working for a few minutes in focus in the region. So I asked my research team, how many co-working centres have you got in your capital city? Asked this question last week, and these were the answers that I was given. Now this excludes service centres, so this is just pure co-working activity. You can see Warsaw 60, Budapest 30, Bucharest they're down at 12, Bratislava 13, and Sofia slightly more at 25. So that's the number of centres. If we look then actually at what's happening with obviously the perceived global leader here is WeWork. What are they doing? They've got 2 operating centres in Warsaw now. Warsaw's the only city where they are present in the CEE region that I cover. They're present also in Moscow at the moment. They have 2 operating centres. They are preparing 3 more right now, and there are 5 more being planned. So they may have 10 centres in Warsaw by a year's time or 18 months' time. So that's what they are doing. They have already leased. So those 5 centres, so the 2 operating and the 3 in preparation, that's nearly 40,000 square metres already leased in Warsaw. So quite significant presence already in Warsaw. So the question is, which the panel may answer, is when will WeWork come to Budapest? Just looking at some of those figures in a bit more depth, we've got this space occupied. So I asked the teams in the locations how much space have the co-working centres that were on the previous slide taken already, and we're looking at around 20,000 square metres in Budapest just for co-working, just under in Bucharest and just over that in Sofia, obviously a bit less in Bratislava. If we look at that as a percent of office stock, so if I take our total office stock figures and divide these figures into the total office stock, we're still only talking less than 1% of total office stock. So it's not yet a significant phenomenon. Obviously in places like London, it's very significant at this point. So we're still only looking at Sofia at 1%. The Warsaw figure there is just the WeWork centres. So it's not the 2 WeWork centres, 10,000 square metres that are operating. We don't have a figure for the Warsaw total space at this point. But the other cities you can see between 0.4 and 1% of space. So it's not yet a significant phenomenon. But in terms of what's the pricing like, at this point we're looking at generally between 100 and 200 euros per month if you want to hire a hot desk. So if you go ring up these co-working centres in these cities, these are the price ranges for just taking a hot desk in those cities at this point. So that's the pricing. So not expensive, I would say. Obviously, WeWork in Warsaw is pricing at around 210 euros, so right at the top of that range. So that gives you an idea of the costs. Now, just to mention, we did a survey a year ago of our clients in the region, looking at where people do their work in the office space in the region. And what was interesting, what we call Agile Working, we asked people, do you have the opportunity to do Agile Working? 15% already said yes. So they were doing either always or most of the time they were doing Agile Working, as in they were having the ability to go and use co-working facilities. So obviously still a significant proportion saying never and rarely. If you look at those proportions, nearly half of the total saying rarely or never. So there's a long way to go in terms of co-working or Agile Working penetration in the region. But but interesting that this is picking up. And then finally, I just wanted to mention, just to give this some balance, WeWork. WeWork is not yet listed. Here I've got a chart that was produced by a research engine, CB Insights. It's just looking at the count of positive news stories on WeWork since 2015, and you can see sort of generally positive and then getting very positive in 2017, 2018. And then very recently, we've seen a plunge in net positive stories on WeWork. This is globally. This is a global survey. So it's just saying that there's growing pains here. Obviously, WeWork's supposed valuation, the investments by SoftBank into WeWork have implied very high valuations. And those valuations have actually fallen away in the last few weeks, which is why that plunge has occurred. So it's a sort of challenge here as to whether this business model works, and it would be very interesting to have the panel's perspective on the phenomenon. The news coverage sentiment is volatile. This phenomenon is new. It's definitely worth debating. My personal opinion is I think these assets should be valued like hotels, but that's my personal view. And therefore, we'll see how it goes, but it's obviously very interesting.